Alright, in this video, let's talk about theta. Theta is the Greek that measures the time decay, how much value your option loses every single day just because the time is passing. Even if the stock doesn't move, your option could lose money, and that's theta working against you. Think of it like leasing a car. Every day, even if you don't drive, the value goes down. That's theta. You're paying just to hold the keys, whether the car moves or not. Say your option is worth $250 with a theta of minus 10. That means your options are losing $10 every day just by holding it. Now here's the detail that confuses a lot of beginner traders. Theta doesn't touch the intrinsic value of your option. It only decays the extrinsic part, the time premium. Let's say Apple is trading at $180 and you own a $170 call option. That is currently priced at $1,200 or $12 in option terms. Now let's break that $12 down like this. $10 is intrinsic value because your strike price is $170, which is $10 under the current stock price. That's real. If you exercise that option today, you would buy that stock at $170 and instantly own something which is worth $180. The $2 extra, that is the extrinsic value. And that's the extra you're paying for time, volatility, and future potential gains. And that's $2 is what the theta eats away, not the $10 of actual value. Think of intrinsic value as the engine already installed in the car. It's yours, solid, valuable. Extrinsic value is like dealership markup for style, paint job, or hype. Fades fast once you drive it off the lot. And theta, it's like daily depreciation on that markup, not the engine itself. So if the more extrinsic fluff your option has, the faster its price melts. In the money and out of the money video explanation, we discussed in depth about intrinsic and extrinsic value and how theta only affects the intrinsic value. And in the money options have both intrinsic and extrinsic value, and out of the money options have only extrinsic value. So when you look at it from a strike price standpoint, in the money options are mostly engine, intrinsic, minimal time rot or minimal theta decay, whereas at the money strike prices have half engine and half fluff, moderate time decay, and out of the money options it's just pure fluff, rotting on a lot every single day. So the next question becomes, what theta should I look for when I'm buying an option? Well, that depends on how long are you planning on holding the same. So if you're just a day trader or scalper, your holding time on a stock is not more than 20 to 25 minutes on average. In that case, the theta doesn't matter much because you're not holding it overnight. In that case, slightly out of the money option to at the money option strike prices works great. Think of it like renting a sports car for a day trip. If you're swing trading, whereas you're planning on holding on to a position for a few days to 1 or 2 weeks, then at the money strike price to slightly in the money strike price makes sense. It's like a mid-size car, reliable daily driver. The theta will be there, but it won't have a lot of impact because your strike prices have both intrinsic and extrinsic value on them. But if you're going for a longer term trade where you're planning on holding it for multiple months, you need to go for deep in the money options or with a longer dated expiration, and think of it like a luxury car with a longer lease. There's going to be theta, but the theta is going to be eating away your premium at a slower rate. Short term, you just need it to go fast. You can tolerate more decay. Long term, you want something that holds true value over time. So here's the road tested version of theta. It only eats away the rental value and not the real equity. As the option nears the expiration, especially the last 2 weeks, the effect of theta, it's going to be faster. Out of the money options only have extrinsic value, which can expire worthless as theta only affects the extrinsic value in the options contract. So when you buy an option, you're not just picking a car, you're deciding how much daily value you're okay losing while it sits in your garage. Just like you wouldn't lease a sports car and park it for weeks, you shouldn't buy an option that can't handle time. In the next video, we will talk about Vega, the Greek that tells you how your option behaves in wild markets, high volatility, and unpredictable conditions. It's like how your car drives in a storm. If you want to learn more, well, check out the links down below in the descriptions. And as always, take high probability trades, manage the risk wisely, and I will see you guys in the next video.